Let me start with a number that should grab your attention. If you invested $10,000 in the S&P 500 back in 1960 and never touched it, never added a single extra dollar, here's where you'd be today. If you never reinvested your dividends, that $10,000 grew to about $143,000. Not bad for doing nothing. But if you took the exact same investment, same stocks, same index, same 66 years, and reinvested every dividend payment back into more shares, that $10,000 became over $7.5 million. Same companies. Same market. Same time period. The only difference between $143,000 and $7.5 million is whether the cash that arrived in your account every quarter was spent or put back to work. That gap, a 53-fold difference, is the hidden half of your returns. Here's what a dividend actually is. When a corporation earns a profit, it can reinvest that profit into the business. Or it can distribute some of it to the people who own the business, which is you, the shareholder. That distribution is a dividend, real cash, paid into your brokerage account, usually every 3 months. The dividend yield is the annual dividend divided by the stock price. Right now, the S&P 500 yields about 1.2%. That sounds small. But over the last century and a half, dividends have accounted for roughly 40% of the stock market's total return. And here's the part people miss, that 40% is not a flat add-on. Because when you reinvest dividends, that 40% earns its own return, which then earns its own return, decade after decade. The simple addition becomes exponential multiplication. That's the second engine of compounding running alongside the first. This brings us to the single most important concept in measuring performance, the difference between price return and total return. Price return is what the stock goes up or down, the headline number you see on news tickers. Total return includes dividends, and it's the only number that reflects what you actually earned. The S&P 500 has delivered a 9.53% annualized return over the last 150 years, with dividends reinvested. Without dividends, that number drops to 5.11%. That difference, 4.42 percentage points per year, may not sound enormous. But over 40 years, a 5% return turns $10,000 into about $70,000. A 9.5% return turns the same $10,000 into over $430,000. That gap, over $350,000 on the same initial investment, is entirely the work of dividends and reinvestment. Every year, you're not just earning returns on your stocks. You're earning returns on the cash those stocks already paid you. And that second layer of compounding is invisible unless you deliberately look for it. The most compelling data comes from Hartford Funds and Morningstar, who updated their research through 2025. Since 1960, a staggering 85% of the cumulative total return of the S&P 500 came from reinvested dividends and the power of compounding. Not 15%. Not 30%. 85%. The reason is that reinvested dividends don't just add to your return, they compound on top of each other. You get a dividend. You buy more shares. Those new shares pay dividends too. Those get reinvested and buy even more shares. The loop feeds itself. And because this is exponential, most of the benefit shows up in the later years. The first decade of reinvesting feels like nothing is happening. But by the third and fourth decades, the compounding of dividend on dividend overwhelms everything else. Price return alone tells you about price. Total return tells you about wealth. Dividends matter most when markets are falling. In 2022, the S&P 500's price return was negative 19.44%. But the total return, including dividends, was negative 18.11%. That 1.33% cushion seems small. But consider the lost decade from 2000 to 2009. The price return was negative 9.1% annualized, one of the worst 10-year periods in market history. Yet with dividends reinvested, the total return turned positive. Not high, but positive. You would have lost money on price and still earned a positive total return because dividends kept paying through the crash and the slow grind back. In every single down year in the last 50 years, dividends have reduced the loss. And because reinvesting in a down market buys more shares at lower prices, the recovery that follows turns those cheap shares into amplified gains. The cushion becomes the catapult. Now let me walk you through how this works in practice. A dividend reinvestment plan, DRIP, is exactly what it sounds like. Instead of receiving your dividend as cash, you instruct your broker to use it to buy more shares automatically. Most major brokerages offer DRIP at no cost. Vanguard, Fidelity, Schwab, Interactive Brokers, all have a one-click setting to turn it on. The math is straightforward. $10,000 in a stock yielding 2% pays $200 in dividends the first year. Reinvested, you now own $10,200 of stock. Next year, 2% on $10,200 is $204. The snowball grows on its own. Over 20 years at 2% yield plus 6% price growth, reinvesting dividends adds roughly 33% more to your ending balance compared to taking the cash. That's 6 extra years of compounding for free. There's an even easier way with exchange-traded funds. Accumulating ETFs, tickers like CSPX or VWRA, automatically reinvest dividends into the fund's net asset value. You never see the cash. You never have the option to spend it. The compounding happens inside the fund, invisible and continuous. For retirement accounts, any standard ETF with DRIP enabled does the same job. The wrapper matters less than the decision to reinvest. But here's where most people get it wrong. The psychological difference between growth and income is dangerous. Growth feels abstract and risky. Income feels real and safe. When a dividend arrives as cash in your account, it feels like a bonus on top of what your investments are doing. This is an illusion. That cash is not free. It is a return of corporate profit to you, the owner. If you spend it, you are consuming your portfolio's compounding ability. A $100,000 portfolio yielding 2% generates $2,000 in dividends each year. Reinvested over 10 years at 7% total return, that's over $44,000 in additional growth. Taken as cash, it's exactly $20,000. You've kept the cash and lost the compounding on every dollar you took out. The real-world trade-off is stark. A $500,000 portfolio with a 2% yield generates $10,000 in dividends annually. Reinvested for 10 years in a market returning 7%, your portfolio grows to over $983,000. If you take the dividends as cash for 10 years, it grows to only about $885,000, assuming the same price return. The difference is almost $100,000. Same portfolio. Same market. Same 10 years. The only variable is whether you let the dividend engine run or disconnected it halfway. The practical steps are simple. Step 1. Log into your brokerage account and check whether DRIP is enabled. If it's not, turn it on. It takes 30 seconds. Step 2. In your IRA, 401k, TFSA, or RRSP, always reinvest dividends. These accounts have no annual tax on reinvested income, so the full compounding benefit flows to you tax-free. Step 3. For taxable accounts, consider accumulating ETFs that handle reinvestment automatically. Step 4. Never buy a stock purely for its dividend yield. A high yield can signal a company in distress, and a dividend cut destroys more value than the yield ever added. Buy quality businesses with sustainable competitive advantages. Let the dividend be the bonus engine on top of the compounding that quality delivers over time. The 150 years of S&P 500 data tells a clear story. A 9.5% annual return with dividends reinvested versus 5.1% without. 85% of cumulative returns coming from reinvested income compounding. A 53-fold difference on a single $10,000 investment over 66 years. These are the actual historical numbers, calculated by independent research firms, available for anyone to verify. And they all point to the same conclusion: the hidden half of your returns is hiding in plain sight. It's the dividend cash flow that public companies send to their owners every quarter, year after year. And the only thing standing between you and that compounding engine is the tick of a checkbox, a setting in your brokerage account that takes less time to change than it takes to brew a cup of coffee. That's the math. The rest is just one click away.